is talking about accounting changes, and we're going to particularly talk about the difference between the voluntary versus involuntary, right? So, talking about changes in principle, right? And we have voluntary and involuntary. Okay? And so if we have a voluntary change from principle, which means that we basically decided to go from FIFO to LIFO, well, what happens is that all voluntary changes based on our own accordance requires a retroactive restatement. A retroactive restatement. So basically, this is what this means. We have an annual report that we list, that we distribute out to the shareholders, all companies do. And basically that annual report discusses several things, but within that annual report consists of comparative financial statements. And when I say comparative financial statements, I mean financial statements from a historical perspective leading up to the particular year of disclosure. So not only would you have this particular year's financial statements, you would also be able to compare with previous years. Most of the time they go out 3 years back. Some companies go out 2 years back. So depending on the time frame of what the company decides to list as comparative financials, if you have a voluntary change in principle, you have to go back and retroactively restate all those financial statements for comparative purposes to show the new change. So basically what I'm saying is, for example, if we change from FIFO to LIFO and it's voluntary, not only will we have to change the effect on income or the adoption of FIFO to LIFO for this year's financial statement, we have to retroactively go back for all of those years, whether it's 3 years, 5 years, and make the adoption change there too, and reinstate the financial statements. Okay? So that's called a retroactive reinstatement. So that's the only rule that we have for voluntary. Now, what if it's involuntary? What if it's involuntary? Yeah, I'm talking about principle. What if it's involuntary? If it's involuntary, it means that it's basically a rule that's been adopted. We had no influence over it. We had to make that change from FIFO to LIFO. If it's involuntary, you have two choices. Choice one, you can treat it as voluntary and do a retroactive reinstatement. Or, if you decide not to do a retroactive reinstatement, what you can do is calculate the cumulative effect on a change and report it on this year's financial statement. So let me give you an example of what I'm talking about. Say, for example, we have a change from FIFO to LIFO. It wasn't our fault. We decided, well, we didn't have any influence on it. It came from an accounting pronouncement. And so we have an involuntary change of principle, and we decide not to retroactively go back and change the FIFO to LIFO for all the historical purposes of the financial statements. We decide to adopt part two. Well, let's say historically we use for comparative purposes 3 years prior to this particular year. So we report 3 years back of the financial statements. Instead of having to retroactively reinstate each of those 3 years, what we would do is calculate the change in each year on income. If we went from going from FIFO to LIFO, we would add up the change for each year and just report it on this year's financial statement. That is called a cumulative change in accounting principle. So cumulative change of income. Okay, and again, guys, I just want you to identify the rules for this. I would dare not enforce you to make these calculations, but you need to know what to do when this comes into play. Okay? The next thing I wanted to quickly talk about was the change in estimate. Change in estimate. And the first rule that I want you to understand, guys, is we went over change in principle. Now we're about to do change in estimate. And I know some of you may think that depreciation should be considered like a principle, right? Going from straight line to units of reduction to double decline, or whatever. That's a change in depreciation methods. But what you need to understand is that if you change depreciation methods, you treat a change in depreciation methods as a change in estimate. All changes in depreciation methods shouldn't be treated as a change in principle. It needs to be treated as a change in estimate. So how do we handle changes in estimates? Well, a change in estimates are relatively easily. We don't have to retroactively go back and change anything. All change in estimates require for you to just make the change on the current year and move forward. So you proactively change the method. So you proactively change method in current year and move forward. Pretty simple. Okay? And the next one that we were going to talk about would be a change in entity. And we're not going to go in detail with that. I just want you to be aware that a change in entity would be considered an accounting change. Each one of these changes in estimates, changes in entity, changes in principle, need to be reported net of tax. And so that's just going to summarize up our changes in our accounting changes.